Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I'm going to share with you guys 10 companies that are my all-time favorite companies out there. I do own them in this portfolio. I'm going to share that with you guys today. All I need you to do is just make sure you do your own research. These are my favorite companies. It doesn't mean, they're great investments right now. In my opinion, they are, but of course you have to do your own research. And, I own 26 different companies in this portfolio. 10 made the cut. There's a few that's actually I've left out because I couldn't fit all of them in, of course, in here. But these 10 are genuinely my favorite companies out there. So I'll share that with you guys. If you are new to the channel, okay, this is my actual portfolio, Trading 212. If you haven't actually started, if you have not used the Trading 212 or you haven't actually started investing, it's a great platform to use. Okay, I have been using it for 4 years now, and as you can see, my portfolio has now grown into over £100,000. And yeah, that's basically, this is real money. And if you would like to join this brokerage, then of course there's a link on the description. Just go on that and you will get a free share. I'll get a free I don't think I will actually get a free share this time. I think you will get a free share if you actually end up joining it. Anyway, before we move on, one last thing. If you can join us in the Patreon account, that will be absolutely wonderful. It costs you about 15p per day. You can join on the Discord. There's a Discord including, there's all the buys and sells that I make, all this basically portfolio updates that I also make, as well as the watch list, which I'm updating currently for the next 3 months, the Sharia compliant investing ebook. So there's a lot of little things that you can get basically hands on, as well as join the Discord, which is probably the best thing about this, because there are a lot of wonderful brothers who are sharing good practices that you can join, inshallah. Right, let's get started. I don't want to make this video any longer than it needs to be, but the first company that we're looking at today is Home Depot. Home Depot is one of my all-time favorite companies out there, and some of these companies have something in common, and they have sort of a predictable businesses. Okay, business that I can easily understand, as well as of course that are in demand and so on, and people need it, their products. Of course, some of them might be discretionary like Home Depot, but these are easily identifiable businesses and so on. Then 3 things that I've highlighted are the moat. Okay, the moat rating, which is basically the competitive advantage, if you like, return on invested capital, as well as the free cash flow. So all the 10 companies today have they all have a wide economic moat. They have a return on equity that's absolutely amazing, and they do have excellent free cash flow. So Home Depot, 380 billion market cap, so it's a huge company. Wide economic moat, price $358 per share. Dividend yield over 2%, which is really nice. 56% on payout ratio. Latest increase was 8%. The 5-year growth rate of 14%. 15 years of increase in that dividend. $9 is what you will get for every share of this company that you own. Safety is 87%. The highest any company can get is 99%. Profit margin almost 10%, return on equity over 1,000%, return on invested capital 39%, almost $18 billion of free cash flow right now, which is absolutely amazing. Total return in the last 10 years about 19%, growth estimate next year 7%, then 4% after that. 46% premium right now, $263 per share is where they think the price should be. I genuinely don't think it's that expensive, but I think the price, if it hit around 300, I'm still a buyer for this company. I don't think it will be, that's a massive premium right now. I don't know if that is. I would love to see what they've used for their discounted cash flow models. I would love to see what they've taken into consideration. The next one is MSCI. This is a new addition to the portfolio, so you might be surprised to see, but I like their business. Their business is basically one of those that sticky, very sticky businesses. Have been around for a very long time, kind of predictable. Market cap of $444 billion right now. It has a wide economic moat, $539 per share. Dividend yield over 1%. Payout ratio 41%, which means they can actually increase that dividend if they need to. Latest increase was 16%, and the 5-year growth rate of 24%, which is absolutely huge. I like the fact that they're increasing this dividend massively. Growth, basically dividend streak of 9 years. Annual payout $6.40. Safety 61%. So again, 61% is safe. Anything below that is basically playing with fire, if you like. Profit margin of 12%, return on invested capital 29%, return on equity 29%, and return on invested capital of 35%, which is really good. Over $1 billion of free cash flow right now. Total return in the last 10 years for this company is 30%, which is absolutely huge. Growth estimate for the next year 14%, 13% after that. 15% premium right now. $480 per share is where the price should be. I kind of agree with this 15% premium right now. Probably if it comes down back again for another 5 to 10%, I would love to add to it. I only own 5 shares. I'll show you all the companies at the end. Now the next one is S&P Global, very similar business to MSCI, 133 billion market cap, so it's a huge company. Wide economic moat, $428 per share. Dividend yield just below 1%. Return on equity, payout ratio of 29%, and latest increase was just 1%. I don't even think it was 1%. It was 1.1%. 5-year growth rate of 12%. Dividend streak of 50 years of increase in that dividend. So now they've become a dividend king. Annual payout $3.64. Safety 99%. Profit margin 21%. Return on equity of 7%. Return on invested capital about 8%. $3.5 billion of free cash flow right now. And total return in the last 10 years about 19%. 14% growth estimate expected for next year, 14%. Then 13% after that. Fairly valued basically right now. $410 per share is where they think the price should be. So not far off from where it is right now. The next one is MasterCard, new addition as well to the portfolio. 449 billion market cap, wide economic moat. Price right now $479 per share. Less than 1% dividend yield. So again, it's not huge there. Payout ratio. One of the things that you'll notice, a lot of these companies do not pay a lot of dividends. So I'm not really worried the dividends, the yield up right now. But I'm expecting that to grow in the next few years. That's my expectation. The payout right now 19%, which is really good. So that means they will increase it. Hopefully 17-18% in the next few years, which will be nice. 12 years of increasing that dividend. $2.64 is what you will get. 99% safety, profit margin of 44%, return on equity of 170%, return on invested capital of 61%, over $10 billion of free cash flow right now, 21% total return the last 10 years, 16% growth estimates for the next year, 18% after that, fairly valued, $451 per share. Right, before we move on to the next video, next section or next couple of stocks, please like the videos. It really helps us, and it helps the channel massively, as well as of course it takes a lot of time to put these videos together, so I would really appreciate if you could do that. That would be absolutely wonderful. The next one is Visa. Visa is very similar to MasterCard. Whenever I do analysis of Visa, I always do MasterCard or vice versa. Right now 561 billion market cap, wide economic moat, $277 per share. Dividend yield 0.75, payout ratio 22%, 16%. Latest increase, 5-year growth rate of 16% as well. 15 years of increase in that dividend, $2.08 of payout, annual payout. Safety 99% as well. Profit margin 53%, return on equity 46%, return on invested capital of 34%, and $19 billion of free cash flow right now. That's absolutely amazing. 18% in terms of total return the last 10 years. Again, growth estimate next year 12%, then 12% after that. Fairly valued right now, $260 per share. We've got 5 more to go. The next one is automatic data processing. I've been buying this for quite in the last few weeks. I don't know if I'm done yet, but we'll see. Right now it has a market cap of $100 billion, wide economic moat, $245 billion, $5 per share right now. Over 2% dividend yield, payout ratio of 60%. Latest increase was 12%, 5-year growth rate of 14%, and dividend streak of 49 years. Now that means one more year they will become a dividend king. Annual payout, we're looking at $5.60, which is really good. Safety 97%, 19% profit margin, return on equity of 97%, and return on invested capital of 61%. $3.3 billion of free cash flow right now. 14% total return in the last 10 years. Growth estimate next year is 10%, then 11% after that. Fairly valued, $240 per share. Like I said, this is easily becoming one of my favorite companies out there. Right, carrying on. For whatever reason, the price and the name of the company, because that's automatic data that's been processed, somehow it's not working. So Google Finance is not working right now. Anyway, the next one is UNP, Union Pacific, 150 billion market cap and wide economic moat. Right now price is whatever this should be. I think it's about $242 per share right now. In terms of dividend yield, over just 2%, 50% payout ratio. Latest increase was non-existent, so they didn't actually increase it recently. 5-year growth rate of 11%, dividend streak of 17 years, annual payout $5.20. Safety 88%, profit margin 26%, return on equity 47%, return on invested capital of 15%, and free cash flow $4.7 billion, which is quite nice. 12% in terms of the total return the last 10 years. Growth estimate next year, we're expecting about 13%. Then 9% after that, 15% premium, which I do agree, $212 per share is where the price should be, according to Morningstar. Next one is Hershey, so everything is now back to normal. 39.7, let's call it 40 billion market cap. It has a wide economic moat, $194 per share, 2.82% dividend yield, which is quite nice. Payout ratio 46%, again a very low payout ratio. Latest increase was 15%. 5-year growth rate of 10%, dividend streak of 14 years in a row. Annual payout $5.48. Safety 93%, profit margin of 16%, and return on invested capital of 50%, which is really good. 26% in terms of return on invested capital. Free cash flow $1.5 billion. Total return the last 10 years, we're looking at about 8%. Growth estimate next year for 6%, then 6% after that for the next following 5 years. Again, all of this is estimates, so be careful with that, okay? Fairly valued according to Morningstar, $208 per share is where they think the price should be. We've got 2 more to go. The next one is Procter & Gamble, $382 billion. Wide economic moat, $157 per share. Over 2% dividend yield, 58% payout ratio. Latest increase was 3%. Again, 6% in the last 5 years. 67 years of increase in that dividend. 67 years. That's a dividend king and a half. Wonderful company. $3.76 per share right now. That's what you will get for every share of this company you own. Safety 99%, 17% profit margin, 31% return on equity, return on invested capital of 24%, $16 billion of free cash flow, 9% total return in the last 10 years. Growth estimate next year is 8%, 7% after that for the following 5 years. 16% premium right now, $138 per share is where the price should be. Finally, J&J, $381 billion market cap, wide economic moat, $152 per share. Price and the dividend yield of 3%, over 3% now, which is quite nice. Payout ratio 45%. Latest increase was 5.3%. 5-year growth rate of 6%. 61 years of increase in that dividend. So another dividend king, $4.76 per share. Safety 99%. Profit margin and return on equity somehow disappeared as well. Return on invested capital 23%. Free cash flow of $17.7 billion. Total return the last 10 years, we're looking at about 7%. 4% growth estimate next year. 4% after that. Fairly value right now. $164 per share is where they think the price should be. I think it's becoming basically discounted very soon. I'm not sure what happened to profit margin or return on equity for this, but everything else is actually working at the moment. So that's the 10 companies that I wanted to talk about today. And the reason is I really genuinely like these companies because, one, they have a competitive advantage. They do have excellent free cash flow. They do have absolutely great return on invested capital apart from S&P and Global. And one other thing I love about these companies is when it comes to these numbers here. Okay, what I want to see is I wanted these companies to increase this dividend year after year, because remember the yield here is absolutely not existent for a lot of these companies. So basically I want to make sure these companies continue to increase that dividend year after year in the future. And the fact that the safety is basically over 61%, which is really good. A lot of them have 99% and so on. So these are the reasons why I really like these companies. I'm just going to quickly show you in my portfolio, so where you can find these companies. So automatic data processing we talked about. Broadcom was another one I left out, but it could have made the cut. Cummins, I really like it as well. Hershey we talked about. Home Depot we talked about. J&J, MasterCard we talked about. MSCI we talked about. Procter & Gamble and S&P Global. Union Pacific, and Visa. So those are the 10 companies. All of them I do own in my portfolio. If you are new to the channel, please subscribe to the channel. Of course, like the video, so let me know if you have any questions, and of course please join us on the Discord, where you get access to a lot of things, and it really genuinely helps the channel. 15p per day is not a lot, but you can gain a lot from it, inshallah. Have a wonderful day. Assalamu Alaikum.